President Trump announces 10% tariffs on the final $300 billion of Chinese goods imports will come into effect September 1, escalating the trade war and shaking global financial markets. It's been a week of two halves for global investors. Equity markets around the world hit record highs early in the week on optimism that US-China trade talks in Shanghai might have brought Trump and Xi closer to a solution, and that the Fed would cut rates and lay the groundwork for another cut later in the year. But that optimism started to give way Wednesday. While Fed Chair Powell did deliver the rate cut the market had discounted, the message he presented did not sit well. The rate cut was described as a mid-cycle adjustment rather than the beginning of a new easing cycle. Indeed, during a nervous press conference, Powell stated that "I'm contrasting it there with the beginning of a lengthy rate cut cycle." This saw global equity markets slide around the world as traders moved to discount the Fed's message. The US dollar surged to multi-year highs, and a commonly watched index of the US dollar against its major trading partners, the DXY index, hit highs back to May 2017. Adding to confusion in the markets, Trump dropped a series of tweets late Thursday that saw the correction in global markets continue with a vengeance. Trump announced that the US will start on September 1 putting a small additional tariff of 10% on the remaining $300 billion of goods and products coming from China into our country. Later going on to say that the new 10% tariff rate can be raised beyond 25%, that the new tariff is for a short period, and that he was not concerned about market reactions to the tariffs. Given that the vast majority of these products are final stage or consumer products, including cell phones, laptops, video game consoles, monitors and flat panels, they will have a direct impact on high street prices and the consumer in the US. While Trump stuck to his point that China, not US consumers, bears the brunt of the tariffs, it's clear that markets simply do not agree. US money markets are almost fully priced for another rate cut in September and a total of 2 quarter-point rate cuts by the end of the year, despite the Fed governor's message painting a very different picture just 24 hours prior. Remember that the global economy is facing a number of acute challenges into the end of the year. Global trade has slumped as a result of Trump's tariffs. Another round of trade wars in September would arguably intensify this headwind. The UK appears set for Brexit by any means at the end of October, and we have the potential for Trump to announce auto tariffs in November as part of the Section 232 auto investigation. This 1-2-3 punch of hits to the global economy in Q4 will add to risks to the outlook, and bond markets around the world have rallied hard. US 10-year yields dropped below 1.9% last night for the first time since November 2016. 10-year German bond yields dropped to a fresh all-time low of minus 45 basis points. Now, none of this has been good for the Australian dollar. The RBA governor's lower for longer ANICA speech last week, where he noted that it's reasonable to expect an extended period of low interest rates, and if demand growth is not sufficient, the board is prepared to provide additional support, added to the pressure. And over the last 2 weeks, the Aussie dollar has lost 3.8%, beaten only by the Norwegian kroner. Now, that pressure intensified last night on Trump's trade war tweets, and the Aussie dollar briefly traded 68 cents, which is our long-standing target for the end of this year. The Aussie dollar's only traded below this point on one flash crash day back on the 3rd of June this year. Prior to that, you have to go back to March 2009 to find a lower level for the Australian dollar. Now, next week may present challenges for the Australian dollar too. The RBA will deliver its interest rate decision Tuesday. While rates will remain unchanged, the statement will likely mimic the lower for longer and prepare to act language that Lowe used last week. Friday next week also sees the statement on monetary policy, where a downgrade to the RBA's 2019 growth forecast seems likely. In New Zealand, we expect the RBNZ to cut rates Wednesday and indicate a strong easing bias in the guidance paragraph. Thus, the New Zealand dollar could remain under pressure next week as well. While US-China trade relations will remain the key driver for global markets next week, we do have a couple of Fed speakers, and given trade developments, guidance on how much this has added to the trade policy uncertainty, Powell highlighted this week will be important. These are all factors we'll talk about in next week's Markets Update.